Okay, let's talk about the problems associated with valuing stocks from Chapter 9 of our textbook. The first problem is just a basic valuation issue, right? We have a company paid a dividend of $4.50. Current stock price is $75.50. The dividend is expected to grow by 5% for the foreseeable future. Investments with equivalent risk have an 11% expected return. So what is the dividend discount model value that you would get for this particular stock? So if we open the stock valuation dividend model, we need to start to find out where to put the data. The required return that you're told is 11%. We're also told that it's going to grow, or dividends are going to grow by 5% for the foreseeable future. The stock price you're given is $75.50, and you're told that the current dividend was $4.50. So given this information, we can plug in, we can find out that the current stock value is $78.75. The expected return, if you were to pay that, you would expect to earn 11.3%. And of course, you wanted 11% based on its risk level, and the value is, the price is less than the stock value. So it turns out that this particular stock is a good investment. This company paid a 3% dividend. Dividends are expected to grow at 7%. The required return on the stock's equity is 16%. What is the value of this stock? And again, the second part of the question is, if the stock traded at $37, what would you do? And again, this is just a similar question. You plug in the data. The most recent dividend, $3, 7% growth, 16% required return. This stock has a value of $35.67. Would you pay $37 to get $35? And of course you would not. However, if you did buy the stock, right, at $35.67, your expected return would be 15.7%. And of course you wanted 16%. So this is just an example of a stock that you would not want to purchase. So if we look at some data that we can gather for a company, right? We can find the risk-free rate of return in a variety of places that we talked about in class. The required return on the stock market, or the average return in the stock market. We saw some data that said that that number could be somewhere between 9 to 11 or 12%. So I chose 10%. You look up the beta, 1.65 is the beta of this company. The dividend yield, again, we can find this on places like Yahoo Finance, is 8.75. Return on equity, 7.89. The dividend payout ratio is 47%. We looked up the current market price is $32.50. We also have the dividend history. So in 2008, the dividend was $2.25, and that grew fairly steadily to 2012 when it was $3. So again, using the dividend valuation worksheet, we can start to plug in this data. So let's work with dividends first. If you notice, right, we have the dividend stream, right? It went from $2.25 to $3. We plug in here, the first dividend was $2.25, $3. There are 4 growth periods there. You have 5 years of data, but that means there's only 4 growth periods. So using time value, the growth of dividends is roughly 7.46%. But you can also use the earnings growth rate model, retention model, right? So if you put in the dividend payout ratio of 47%, that means the company reinvests 53% of its profits, and those profits earn 6.26%, the return on equity. So this means that the company should have a growth rate on future investments of roughly 3.32%. If we average those out, right, we roughly get a growth rate of around 5.39%. So I took the averages of these two numbers. How did we get the required return? Again, plug in the data that we know that relates to the capital asset pricing model. We have 3.12% is risk-free, 10% the stock market return, their beta of 1.65. The capital asset pricing model says this stock roughly has a 14.47% required return. If we look at the dividend yield basically is provided for us in the data of 8.75%. So this means that using the dividend yield plus capital gain formula, we end up with a 14.14%. Again, averaging those numbers, we roughly get 14.3%. So the stock's value is roughly $35.47. The stock price we mentioned is $32.50. You would pay $32 to get $35. If you bought the stock for $35 here, you would actually, if you buy the stock for $32.50, you would actually earn 15.12%, which is obviously better than 14.3%. So again, for problem 3 here, we've identified a good investment for the company. We've talked a little bit about what's referred to as supernormal growth stocks or variable rate growth stocks. Basically, this happens with companies that have innovation, right? So here's a company, Small Fry Inc. They invented a potato chip that tastes just like a French fry. Given the phenomenal market response, they are expecting all of their earnings, obviously to expand its operations. Their dividend this year was $2.95. They expect this to grow at a rate of 20% for the next 4 years. At that point, they're expected to go back to the industry average, which is roughly 9%. So if Small Fry's equity cost of capital is 15%, what is the value of the company's share of stock today? So we use the stock valuation supernormal growth stock worksheet. Again, enter the data we know. Current dividend, $2.95. The normal growth rate, that's the average growth rate, really is about 9%. But because of this innovation, we're going to experience a 20% growth rate for the next 4 years. And again, the required return, 15%. So what this model essentially does is it calculates the next 4 dividends. It then also calculates the price at the end of that time frame. And then it adds them all together. So it finds the present value of the 4 dividends plus the price at the end of the 4th year. So the value of this stock is roughly $76.68. Problem 5 talks about the total payout methodology. This company has 217 million shares outstanding at the end of this year, right? And they expect to have earnings, and expect earnings at the end of this year to be 860 million. Titan plans to pay out 50% of its earnings in total, 30% as a dividend, and using 20% to repurchase shares. If Titan's earnings are expected to grow by 7.5% per year, and these payout rates remain constant, find the share price assuming an equity cost of capital of 10%. And I'm going to fix this. You'll see it in the expects. Thank you. Anyhow, So how do we find this? We need to go to the model. It's the stock valuation total payout model. It's actually very simply, what are the dividends that they expect to pay out? Right? We said that they're going to pay out 30% of their earnings. 30% of 860 is 258, and the other 20%, right, of their earnings, they're going to pay 50% of their earnings, 50% of 430. 30% of that is $258, and 20% then is the amount of repurchased stock. Weighted average cost of capital is 10%. Number of shares, we said, were 217 million, and the growth of their earnings is expected to be 7.5%. So this stock, using the total payout model, would ultimately have a value of $79.26. Keep in mind that these different models look at valuation from different perspectives. They're all coming to the same point, but they all have the same goal as to identify what the value of the company might be. The next model to look at is the free cash flow valuation model. We need to know the cash of the company, the debt of the company, how many shares they have, what is the growth of their free cash flows, what is the current year's free cash flow. All of this information is available on places like Yahoo Finance. We could find the weighted average cost of capital from the website called that'swacc.com. The interest expense, the tax rate, we expect to have a change in debt of negative 250. So all of this data is then incorporated into the free cash flow model. And it looks very similar to some other things, obviously. 10% is the weighted average cost of capital. 3.75% is what we expect to have as far as growth. How we received or how we got that, the last year's free cash flow was 858. So if we multiply that 3.75% times the 858, we end up with $890,000 is next year's free cash flow prediction. We can also add some other data. We understand something about the free cash flow. That's from above. We know the interest expense is $450. The tax rate's 21%. The net debt increase, in this case it's negative. It's negative 250. So we'll come back to this data, right? The thing that we're looking at initially now, though, is what is the market value of debt? Is $7,358. Cash that's available. So the market value of the common stock is $8,870. The number of shares, 297, means this company has a value per share of 29.86. Again, if we incorporate some of this other information, right, using this, it's called the free cash flow to equity holders. Equity holders are expected to get this $284, if you will, it's in millions. Putting in the cost of equity and the growth rate, we can come up with another market value of equity. In this case, this model shows $4,519 is the market value of equity. And this particular model, looking at the free cash flow to equity, gives us an estimated market value of $15.21. Now the free cash flow model was up here. This is just another model that's provided in this spreadsheet that just shows another way of looking at, again, coming up with an estimate of the value of a company's stock. In problem 7, we're going to look at the multiplier models. Here's the data that we can gather. Again, we get this data from a number of places in Yahoo Finance or annual reports, a variety of places to get this data. So the current stock price of this company is $125.68. The PE multiplier, we put in the company's PE, you're told it's 32.56. Estimated earnings per share 3.95. So that gives us a value of stock of $128.62. This is the value 1 year from today. So 1 year from today, we expect the price to be $128. It's worth $125 now. If you use the price to sales model, 4.29 is the price to sales multiplier. You're told there's 10,000 in sales. 350 is the number for shares. So the estimated share value is $28.57. That's estimated sales per share. Plugging that in, we end up with a value of stock of $122. So this says next year's estimated value is less than $125. Using the enterprise valuation multiplier, 19.27, here's EBITDA, we found the debt, we found cash, we know the number of shares. So the enterprise value multiplier says that the value of this stock next year should be $144.44. So $144.44. Again, that is higher than the 125. Again, the valuation models, again, all of them have the same purpose, estimating value. They all look at different aspects of the business. So they all will have different numbers. As an accumulation, when we use all of these models, we can get a feeling for the range of where we think the stock price should be. Now, I will tell you, when you use this for real data, some of these answers are just nonsensical. They don't make any sense at all. For instance, if we had done this multiplier and it said that the value of this stock was $4, and you know that the current stock price is $125, you know that that information is not working properly with this particular stock. Everything else seems close, but this is $4. Sometimes the models don't always work as nice and pretty as we would like them to. The last thing to look at is the net present value growth opportunity model. And again, this all comes from, and we're going to use the dividend valuation model worksheet. So what we need to do, the only number we need to plug in here is the earnings per share estimate for next year, which is $6.73. So this all goes into that model we used earlier. We can look at this from two views. We can look at it from the investor's view using the current stock price, or we can use it using the stock value that was created by the dividend valuation model. So what both of these things represent to us, though, is that investors are not looking at this company's investment strategy in a good light. They are saying that the net present value growth opportunities of this company are pulling down the value of the stock. It's really worth $47, but they're using the cash of the company, and they are creating negative value for the company. So again, that's really the purpose of this net present value growth opportunity model, is to try to understand what does the marketplace, right? What do the numbers tell us about the company's prospects in the future? This particular model would show us that we would expect the stock price to decline in the future rather than increase. So those are the basic models of stock valuation.